Interest rates. Since the beginning of the year, we've seen an explosion of interest rate yields across the board. The two-year Treasury yield has moved from 77 basis points to 2.58% as of the third week of April. The five-year Treasury yield has moved from 136 basis points to 2.98%. The 10-year Treasury yield has moved from 163 basis points to 2.85%. And the 30-year mortgage has moved from 2.65% to 5.11%. That's an incredible move in interest rates in a very short amount of time. So the question is, what has caused this explosion in interest rates? It can be summed up in one word: inflation. During COVID and the lockdowns, our federal government, because of the economy collapsing due to the lockdowns, started to run trillion-dollar budget deficits. The Federal Reserve also stepped in and flooded our economy and the capital markets with trillions of dollars of liquidity. Unfortunately, as the economy started to take hold and recover, the federal government and our Federal Reserve continued to run deficits and monetize that debt and flood the system with liquidity through quantitative easing. At first, the Federal Reserve and many on Wall Street told you that inflation was just transitory. Well, by November, it was pretty clear it wasn't transitory anymore. I'm a believer that inflation is always a monetary event. And when the Federal Reserve increased our money supply by 39% over a 2-year time frame, at a level our country has never seen in its history, I knew we were going to have a very serious problem. So, over the last few months, inflation has been running year over year at over 7.5% and even 8%, measured by Consumer Price Index, CPI, as well as PPI, the Producer Price Index. These are the two major measurements for inflation. Frankly, I think they understate the pressures of inflation, but now is not the time to address that issue. So because of these inflationary pressures, the Federal Reserve is having to take two actions. Their first action is increasing interest rates. At the Fed's March meeting, they increased interest rates by 25 basis points, but have signaled that they're going to be increasing interest rates at every meeting through the remainder of the year and potentially through 2023. And have signaled that the May meeting may be a 50 basis point rate increase. It is projected that the Fed will end up somewhere between 2 to 2.5% by the end of the year with short rates. The other action that the Fed is taking is not only ending quantitative easing, and quantitative easing is where the Federal Reserve goes in and injects money into the economy by buying Treasury securities and mortgage-backed securities from banks, insurance companies, pension funds, and putting those securities on its balance sheet and sending cash back into the economy, to now moving to quantitative tightening. And that is where the Fed is going to move in reverse and start selling their treasuries back into the market, which will cause treasury yields to go higher, and letting their mortgage-backed portfolio either roll off or selling it into the market as well, which has caused the big move in mortgage rates. So the increase in rates, short rates, and the shrinking of the Fed's balance sheet is how the Fed will be dealing with inflationary pressures. This will, without question, slow the economy down and, in my view, continue to lift interest rates throughout the remainder of the year. The other factor that I think will happen is many investors will wake up and realize the losses they're taking on their fixed income bond portfolios as well as the fact that they've been eating a negative real return. What do I mean by that? If the 2-year Treasury is yielding, let's say, 2.5%, and inflation is running at 8.5%, well, then that person that owns that bond is actually losing 6% of purchasing power per year. Because again, inflation's running at 8.5% and they're only receiving a 2.5% return. So I think more and more people will move out of the bond market and the fixed income market until they feel more comfortable that interest rates will stabilize or maybe even fall again. So because of these factors, I think we're going to be in a continuing lift of interest rates. Hopefully this is helpful, and thank you for your time.